So, how do you figure out what a huge company like an Apple or a Costco is actually worth? I mean, it's one of the biggest questions in all of finance, right? Well, today we're going to break down exactly how it's done.
No, really, think about it for a second. It's not just about the buildings they own or the stuff in their warehouses. It's the brand, right? The people who work there. And, most importantly, it's all about their ability to make money down the road. So the big question is, how do investors take all of that and boil it down to a single number?
Okay, so the very first piece of this whole puzzle is getting your head around this. A company's value isn't just what it has in the bank today. Nope. It's all about the cash it's probably going to generate for years and years to come. But here's the thing. A dollar you get next year isn't worth the same as a dollar in your pocket right now, is it? Of course not. You've got to account for things like risk and, well, just the time you have to wait. And that is the million-dollar question. We have to take all those future profits and discount them back to what they were today. But the rate we use to do that, man, that's everything. If you pick a rate that's too low, you're going to think the company's worth way more than it is. Pick one that's too high, and you'll do the opposite. Getting this number just right, that's a whole game.
Which brings us to the hero of our story today, the cost of capital. This is it. This is the special number that solves our whole problem. In fact, the cost of capital is the discount rate we've been looking for. And to be specific, we're talking about something called the weighted average cost of capital, or as you'll hear it called, WACC.
So, to really get what WACC is, you just have to remember that companies basically get their money from two places. They either borrow it, which we call debt, or they sell off little pieces of ownership, which we call equity. WACC is just the blended average cost of all that money mixed together.
An even easier way to think about it is like this. It's basically a giant blended interest rate for the company. Think about your own finances. Maybe you have a mortgage at, say, 5% and a car loan at 8%. Your personal cost of capital is somewhere in between those two. It's the exact same idea for a huge company, just, on a much, much bigger scale.
And this right here is why it's so important. The WACC is what we call the hurdle rate. It's the absolute minimum return a company has to earn on any new project it takes on. I mean, if it can't earn more than what its money costs, it's actually destroying value for its investors. It's like a financial high jump bar that the company has to clear every single time. All right, so you're probably wondering, how do we actually calculate this magic number? Let's pop the hood and take a peek at the formula. Okay, whoa. Now, don't let this scare you off. I know, it looks like something straight out of a nightmare math final. But I promise, it's actually pretty straightforward once you break it down. It's really just three main parts, all mixed together. So, step one is the cost of equity. That's just the return that shareholders expect for putting their money on the line. Step two is the after-tax cost of debt. And we say after-tax for a really important reason. The interest a company pays on its debt is usually tax-deductible. It's like getting a little discount from the government, which makes debt a bit cheaper. And finally, step three, we look at the capital structure. That's just the mix, how much debt versus how much equity the company's using. Okay, let's dive into what's probably the trickiest part of this whole thing, figuring out that cost of equity. See, the cost of debt is pretty easy, right? It's just an interest rate from the bank. But the cost of equity? How do you figure out the return that shareholders expect for taking on all the risk of investing in a company? Well, to solve this puzzle, finance pros pull out a tool called the Capital Asset Pricing Model. You'll hear it called CAPM. What it does is actually pretty clever. It builds up the expected return by starting with something super safe, like a government bond, and then it adds on an extra chunk of return, a risk premium, based on how risky that one particular stock is.
And the real secret ingredient in that whole CAPM formula is a little thing called beta. The best way to think about beta is as a stock's drama factor. Yeah, seriously. It tells you how much a stock tends to jump around, how much it swings up and down, compared to the entire stock market. And this chart right here shows beta in action perfectly. On one side, you've got a super stable, predictable company like General Mills. Its beta is less than 1, which just means it's less jumpy than the overall market. But on the other side, you've got a tech company like Micron. It's in a way more volatile industry, and its beta is way above 1, which tells you its stock price swings around a lot more dramatically. And really, this all boils down to one of the most fundamental ideas in all of investing, the link between risk and reward. It's simple. A low beta stock means less drama, so it's lower risk. And because it's lower risk, investors don't need as high of a potential return. A high beta stock, though, that's more drama, more risk. So investors are going to demand a much higher potential return to make that risk worth taking.
Okay, that's enough theory. Let's make this stuff real. We're going to walk through the actual cost of capital calculation for a company I think we all know and love, Costco. All right, so the analysts went and crunched all the numbers for Costco. Here's what they found. First, its beta is pretty low, just 0.88, which gives us a cost of equity of about 8.5%. Next up, its after-tax cost of debt is around 3.7%. And finally, they looked at the mix, and it turns out Costco is funded almost entirely by equity. We're talking about 90% equity to only 10% debt.
And this table here shows how we put all those pieces together. It's pretty simple, really. We just take the cost of each part, the debt and the equity, and we weight them based on that 90-10 split we just talked about.
And voila, you get the final number, 8.0%. That's it. Costco's weighted average cost of capital is 8%. That is their hurdle rate. So what this means in the real world is that if Costco is thinking about, say, building a brand new warehouse, that project had better generate a return of more than 8%. If it doesn't, it's just not a good investment for them.
Okay, but before we wrap this up, there is one last really important thing we have to talk about. Even though we use all these fancy formulas, estimating the cost of capital is definitely more of an art than a pure science. It involves a ton of assumptions and, frankly, a lot of professional judgment calls.
You know, the source material we're looking at puts it perfectly. It says that a practical, perfect measurement is elusive. But the goal isn't to get some perfectly precise number. The goal is just to make better business decisions. At the end of the day, the big idea is what really matters. A company only creates value when the money it makes is more than what its money costs. So, that leaves us with one final thought for you to chew on. Think about your favorite company for a second. Maybe one you shop at all the time or a stock you own. Now that you know all this, do you think it's actually clearing its hurdle rate? Is it creating value? Or maybe, is it destroying it? The answer, as you now know, is hidden in its cost of capital.